Hey everyone, hope you're doing well. This is the Deep Dive. My name's Drew Creekmer. I'm joined today by John Creekmer, our founder and senior wealth advisor here at Creekmer Wealth. And John, we're going to talk about some inflation data that came out this past week and walk through the numbers, but also talk about some interesting opportunities. We're always looking for opportunities to help our clients benefit their situation, help them better achieve their goals. But before we do that, John, how you doing?
I'm doing good. I just saw this morning that tipping actually decreased for the first time, I think, in years, like decades. And so people actually giving tips, actually the percentage went down as far as those giving tips. And also the percentage they were tipping also went down. And that has a lot to do with what's called tip fatigue. And I think during COVID, a lot of people started tipping extra. And but now every time you go anywhere, it starts like at 18, 22, and 25%. And being tipped for everything, people are saying, inflation and everything else, we're just kind of tired of that. So that's an interesting thing that I was wondering how long it's going to take for tip fatigue to get in. It looks like it's here finally.
Yeah, that is interesting for sure. So, and you mentioned it, John, you mentioned inflation. Let's talk about it a little bit. So this past week, we got a CPI reading where we saw a month-over-month annual increase of 3.7% here from August 2023, which is actually slightly higher than what was expected. And it does appear that one of the core reasons for that was a large increase in the price of gasoline, which is a major component for calculating CPI. And so, John, whenever we see this, everyone's hyper-focused right now on inflation and interest rates. How do we shift through this?
Actually, I'm just looking up right now, Drew. A lot of the increase was in gasoline up 10.6%. And a lot of that is due to the price of oil. And we're hitting a real inflection point, actually, on the price of oil. And if we get above this next break, it looks like 88.91 is where we're sitting at today. As far as West Texas Intermediate, Brent crude is up again today at 92.18. If we see an inflection point of another 3 or 4 percentage points higher, if we bust through that, it's actually looking like right now, unless something changes as far as with supply, that the prices for gasoline could be going higher. And so, right. It's up 10.6% in August, only up 0.2% in July as far as gasoline prices. Now, keep in mind, folks, that whenever the price of gasoline and diesel go up, we obviously all feel that at the pump when we're filling up our vehicles. But it's also accretive, and so in other words, it's additive to all the cost of everything else that's out there. And so in other words, what does that mean? Well, let's say that they happen to have picked some vegetables over in California. They're going to be shipping those to be consumed in Central Illinois. Well, how did they get here? Well, they're inside a diesel vehicle that ends up bringing them across the road over to Illinois. Well, the cost of diesel is higher, therefore the cost of your avocados is going to be higher, and so therefore they have to actually mark it up at the grocery store. And so whenever we see gas prices going up, it's a really economic sensitive item that's going to be able to come down as far as the bottom line of all of our expenses. And so we'll look to gasoline prices and diesel prices really as an indicator of what's going to happen to inflation in the next month.
Yeah, it definitely is. And Johnny mentioned supply. I do know OPEC. They have already said they are not increasing supply. So we know that there's a constrained supply right now in the oil markets. And it'll be interesting to see what ends up happening with price on that front. Now, John, let's kind of talk about it. The last couple of times we've done a deep dive, I've been trying to find ways to help folks, pick up nickels. And a nickel isn't that much, but over time, if you pick up enough of them, it adds up to a large sum. And so today I want to talk to you about something that has to do with interest rates having gone up and the term refinancing. And I think when most people hear the term refinancing, they don't think high interest rates. They think low interest rates. So can you kind of walk us through what is this concept of refinancing in a high interest rate environment?
Yeah, so refinancing, traditionally, that's going to be of debt or loans that you have. So let's keep it on the simple side and say you have a house loan and you're sitting there in your house loan and you have a 30-year mortgage and your interest rate's 6%. And then interest rates go down, and so now a new 30-year mortgage is at 4%. Well, 6% versus 4%, in that period of time, interest rates went down. You say, I'm going to refinance my house loan. And so you're going to pay certain costs as far as a new loan origination fee. Or if you have certain banks or credit unions, they might just charge you a certain flat dollar amount to refinance or change the interest rate you're being charged on your home mortgage. So you're refinancing the loan, and typically that comes for a lot of people being a lower monthly payment as far as what they're paying. However, refinance, the concept, actually applies whether we're in a decreasing interest rate environment or an increasing interest rate environment. But the difference is whenever rates are increasing, well, obviously you're not going to refinance your mortgage. Let's say you have a 3% mortgage. You're not going to refinance it to 7.5% of where it's at today. But this is more on your investment side. And so it's looking at your current investments and saying, what am I getting paid right now on some of my fixed interest rate investments? It might be a CD, it may be an annuity, it may be a bond. In those times, whenever interest rates go up, you want to be looking to say, should I refinance my asset or my investment in order to get a higher interest that I earn? Now, we talked about picking up nickels, Drew. We've actually seen people that pick up more than nickels. They're picking up singles and fives and tens and $100 bills because they were in an interest product, maybe it was a CD, in which they were getting paid 1% on their CD, and now they're getting 5% on their CD. And so we've seen a number of folks actually say, that cost is actually, instead of having, whenever you refinance your house, you pay a closing cost or a loan origination fee. Well, that's a cost that you pay. But whenever you're talking about refinancing, maybe you say, I want to cash in my CD and have an interest penalty. But it's okay to pay that penalty in your situation because you're going to go from getting 1% to getting 5%. And so it's refinancing. We see it also right now, a lot of folks, they have fixed annuities, that they have the ability to refinance their fixed annuities. And for a lot of them, they're getting a bonus up front between 12 and 18% interest credit in the first year. But they're also going from maybe a 3% interest rate up to a 5 or 5.5% interest rate. And so in some situations, it makes sense to do that, Drew.
Yeah, absolutely. And I know you mentioned annuities. One thought that I had as well was in any type of cash value or term life insurance. We've done some insurance audits recently on some old policies that folks had where the position was able to be drastically improved for no increase in premium, meaning larger death benefit or more long-term care coverage without adding additional premium. And that's just another way that right now higher interest rates, you're able to refinance along the lines that John was talking about.
And Drew, I'll tell you what, that's a great concept. And we've even seen some folks that maybe they have a long-term care or disability policy they're paying monthly premiums on. In addition, they have a life insurance policy. And maybe they had purchased all those policies years ago. Well, then now with interest rates having changed, pricing on new insurance policies are actually cheaper in most cases. And so as long as your health has not changed significantly, it might make sense to refinance your life insurance policy, but combine it together in a hybrid policy where you have life insurance, long-term care, and possibly disability all inside of one policy, saving you money monthly on your premiums and making sure you have the coverage that you need going forward.
Yep, absolutely. And so it's one of those things, whether you have maybe some cash in the bank or some old CDs or a fixed index or a fixed annuity or maybe even a life insurance policy that's out there, our team right now has built out a really great process to do an audit on those positions for you to see if refinancing makes sense. And so, John, what would we encourage folks to do if they're kind of curious about the refinancing situation?
I'll tell you what, no matter what your solution is you're looking at or your need is, whether it's on the insurance side, the annuity side, or it's on even some of your other fixed income allocations, you want to pick up the phone, give a call to your advisor, and just say, hey, I want to walk through a refinance discussion about this topic here. Or you can go to the website at creekriverwealth.com, and a little pop-up will pop up there that says, hey, how can we help? Or let's chat. And there's a picture of Stacy on there. Just go ahead and mark that and say, I'd like to talk to someone about refinancing my fixed interest or refinancing my long-term care or life insurance policy. And we'll do an analysis. And from there, with the information from you, we'll do the analysis and get you back some solutions that make sense to walk through that or not.
Yeah, absolutely. So definitely reach out to us, folks, if this is something that intrigued you or you know that you could benefit from the situation. Our team is standing by and ready to help you. And with that, John, I think that's all we have for today. So we'll sign off and we'll talk to you all later.
Great. Talk to you all later.